Welcome to Cross-Border Tax Talks, where we discuss the latest trends in international taxation, from UK tax reform to the OECD's latest developments. I'm Doug McHoney, PwC's International Tax Services Global Leader. You can watch these podcasts on YouTube at youtube.com/Doug McHoney. On this week's episode of Cross-Border Tax Talks, we're at PwC's Global Tax Symposium, Europe 2022 in Barcelona, Spain, where I'm excited to have Matt Ryan back on the podcast. Matt is a UK-based international tax partner with PwC, leading the charge on Pillar 2 in the UK. Matt, welcome back to the podcast.
Thanks, Doug. Great to be back.
All right. Well, Matt, there's been a lot of international news after the short tenure of British Prime Minister Liz Truss and her replacement Rishi Sunak. For those of us that are still a bit baffled by your parliamentary process in the UK, can you remind us, how is a PM elected?
Sure, Doug. And I think it should be simpler because the US process baffles me as well. But I guess,
I can understand that.
Each to their own.
Right.
So in the UK, you have a committee that determines how many votes are required or how many supporters are required for each person to put themselves forward for the process where they get votes. So,
and this is a committee that sits within...
committee that sits within the Conservative Party for the Conservative elections.
And the members of Parliament sit within that committee.
Certain members of Parliament sit within that committee, and they determine the rules of each process. But broadly, you have to have a number of supporters put you forward for a vote. You then have a number of candidates, and then the Conservative Party members, the MPs, are voting for their preferred candidates. And then each time in the process, one person gets eliminated and then you re-vote till the point in time at which you get to the final two candidates. And then the MPs have their final two preferred candidates, and then it goes to the party to vote. And so you can end up with the position where the party has a preferred candidate, one of those final two members has more votes than the other, but the party determines the outcome. And that actually happened with Liz Truss versus Rishi Sunak. Rishi had more votes for the party, but Liz Truss got more votes from the actual party members. And so Liz Truss was the Prime Minister, as you say, for a short period of time. And then that process restarted once she'd stepped down, but we ended up with the candidates just standing back and letting Rishi Sunak be the sole candidate. And now here we are with Rishi Sunak as the Prime Minister, and hopefully from a stability perspective for a longer tenure than Liz Truss.
So if I play that back, there's a committee of the party members within Parliament that selects those, and then they provide them, and then they have a vote to the larger MPs who are all part of the party to ultimately make the election. So when or why would there be a call for an election? So this is the other thing I think that confuses many of us Americans, is that sometimes the Prime Minister will have a call for election, and I'll be honest, that sometimes I'm like, well, aren't you already the Prime Minister? Why do we need to have a call for an election?
Yeah, well, I think it's if you're riding high in the polls and you think you can call a snap election and get voted in and increase your majority, a greater majority gives you a greater chance of getting your bills through Parliament. And so, you can call that snap election.
And the election is really for all of Parliament. It's not necessarily the Prime Minister, because you start to go through the Prime. That's what I think is the confusion for those of us, not in a parliamentary system.
So that's it. So you're in the position where your Prime Minister is an MP's and then members vote, but then the party is elected by the wider public. And so, if you're riding high in the polls, you'd call a snap election, get a greater majority, and then that increases the stability of your government. And that's what Boris Johnson did. He wasn't Prime Minister that long ago, so as you say, there's been a bit of movement in the UK, but I think Rishi Sunak, my prediction is he is not going to call a snap election. The Conservatives are not riding high in the polls at the moment, and so I think we're we're basically waiting until the end of Rishi's tenure, the end of the Conservative Party's current tenure, till we go back for another election.
Got it. All right. Well, this is the Cross-Border Tax Talks podcast.
We should talk some tax.
Not the parliamentary process podcast, which would have a lot fewer episodes and a lot less content. So let's talk some tax. So Liz Truss, the former prime minister, proposed, amongst other measures, stopping of the corporate tax rate increase from 19 to 25%, and then reducing the tax on the wealthiest Brits. We already saw how that went. It arguably tanked the UK
absolutely.
economy. There was significant pushback. And so it's mid-November now, and Prime Minister Rishi Sunak, Finance Minister Jeremy Hunt, recently proposed some significant changes to UK corporate taxation. What are those proposals, Matt? What should corporate taxpayers be focused on?
So I should correct you, Jeremy Hunt, the Chancellor of the Exchequer in UK terminology.
Okay,
so
fair enough.
Fair enough. He has confirmed we are increasing the rate, as you said, from 19 to 25% April next year.
So April 2024,
April
we're going from
2023.
19, or April 2023, we're going, sorry, I'm confusing that with our Pillar 2 discussions, which we'll get to in a second. So April 2023, 19 to 25%, that is a significant increase.
Yeah, but there's a budget deficit in the UK at the moment. The UK is forecasting to go into recession in 23, albeit with a forecast for that to be a short recession and to come out in 24. So there's a need to plug the budget deficit, which is being done by a combination of tax increases and spending cuts. Most of the tax increases actually are from a personal tax perspective, but yeah, the main one from a corporate tax perspective is that increase of the rate to 20%. Some reliefs, the UK R&D tax credits are increasing to a 20% credit. That's a pre-tax credit, so for every £100 that you spend on R&D in the UK, it will effectively cost you £85 because you get that credit of 20, taxed at 25%. So it's essentially 15 back for every 100 you spend, so net cost of 100 on R&D,
and
85.
And those R&D credits, unlike the US system, are refundable credits.
Refundable tax credits from a Pillar 2 perspective, so good credits not sat in your tax line for Pillar 2 purposes. They sit in your income, and so they don't dilute your Pillar 2 effective tax rate.
Okay. So the big news, I think, coming out of these proposals is Pillar 2. So let's dive in.
It enables us to dive straight into Pillar 2, because announced yesterday, the UK has confirmed it is moving forwards with Pillar 2. We will get revised draft legislation in the spring next year. So we expect Q1, Q2. We'll have revised legislation in the UK. It will apply to accounting periods commencing on or after 31 December 2023. The income inclusion rule is being introduced first, but the UK has also announced, which was somewhat unexpected yesterday, that the UK will also push forwards with a qualifying domestic minimum tax. So that's essentially applying the Pillar 2 rules to UK companies as well, not just their overseas subsidiaries. And another announcement is that we will apply the qualifying domestic minimum tax to UK-only groups. So a level playing field if you're a UK-only group or an international group. Both will be subject to the Pillar 2 rules on their UK.
And just to make sure that we clarify, that is January 1st, or tax years beginning on or after December 31st, 2023.
2023,
So really, practically, because I still haven't found any taxpayers whose tax years begin
There were a couple.
on December 31st.
There were a couple on December 31st.
Excellent. I have not run into any of those taxpayers. I had a feeling there were a couple out there. A little odd, but all right. But I think, so for most taxpayers, it's really January 1st, 2024, which is when these rules will come online.
Yeah, absolutely. The income inclusion rule applying to the overseas subsidiaries of UK companies, and then for the UK companies themselves, the qualifying domestic minimum tax, which we expect is very similar to the income inclusion rule, but we need we need to wait to see those details.
And to your point, whether you're a UK parented group or you're a UK subsidiary of the US or any other jurisdiction, the qualified domestic minimum tax will apply to both. The income inclusion rule, so for UK parented groups, any subsidiaries below the UK would be subject to these Pillar 2 top-up tax rules to the extent that you're German parented or US parented and have a UK holding company, which there are quite a few of. Then those taxpayers need to be mindful of any subsidiaries sitting below the UK, potentially subject to the income inclusion rule. Was there anything in the rules that gave any insight onto the undertaxed profit rule and when that may come into play?
So, yeah, a statement in relation to the undertaxed profit rule that the UK is intending to proceed with it, but the earliest it will be introduced is 31 December. Accounting periods commencing on or after 31 December 2024. So a definite year gap, but as we said, it's the earliest, so potentially a later start date. So no commitment to the specific start date, only a commitment that it will not be before essentially 2025.
And the revenue estimates for this in the UK, and we definitely don't need to go into that process because it's a bit bewildering in the US as well, but I think I read it was roughly about $2 billion per year.
$2 billion per year
think
is the forecast of increased revenue. So $2 billion to go towards plugging that deficit I mentioned.
So Matt, this is really probably the most important question that I'm going to ask during the podcast here. So does this mean now that the UK is willing to go first? We've spent so much time in the cross-border tax talks and we know that if one country moves forward, other countries are going to likely follow, because if the other countries don't follow, then in 2025, particularly when the undertaxed profit rule comes in, the UK can potentially collect the top-up tax for the entire globe, which incentivizes other countries to follow and enact before then. Is the UK going to be the first ones to jump?
I think the UK is definitely committed to that timetable I mentioned, and so to the extent that no one else pushes forwards, then yes, I think the UK would be first. We've seen what happens in the financial markets in the UK to the extent that the UK doesn't stick to what it's previously said it's going to from a tax perspective. So I think politically, yes, the UK is committed. But as we've seen, Doug, there are other countries out there who've said that they are going forwards and implementing to that same timetable. Within Europe, you had the 5 countries,
right.
France, Germany, Spain, Italy, Netherlands, who've said that even if we don't get unanimous approval on the EU directive, they will be pushing ahead with that same implementation date as the UK. So I think based on those political statements, the UK isn't expecting to go first, but obviously if everyone else stepped back, then the UK's stood there by themselves at the front of the queue. But I think, yeah, we committed politically that we're going ahead.
Yeah, it's a great point, and I think an important distinction. So I'm with you. I think it's not very likely that the UK is really going to go first. They're the first ones really to announce that they intend to enact this legislation, and so then everybody else can join the UK at the front of the queue, so to speak.
Yes, absolutely.
Yeah, I think that's a good characterization. So the UK has been going through, with respect to Pillar 2, a consultation process. So they have already proposed some rules. There's some draft legislation that's out there. Tell us a little bit about how does that consultation process just generally work in the UK as you're drafting proposed legislation?
Sure. So, yeah, you mentioned we got the draft legislation. So you get the draft legislation, and then alongside that, there's a policy document that generally sets out what the UK is intending to do with the Pillar 2 rules, and it asks certain questions around what the UK should do in respect of these rules. But given that essentially it's a minimum standard, there's not much wriggle room from a UK perspective to divert from the rules, or it wouldn't be a qualifying income inclusion rule, which we won't go into the detail, but has some adverse consequences in terms of certainty over the application of Pillar 2.
Yeah, we know that from that resonates as a U.S. practitioner as we think about GILTI, because we know think that obviously is likely not a qualified income inclusion regime. So I think the point is, as closely as the UK can stick to the model rules and commentary, it is more likely that it will be respected as a qualifying income inclusion rule in UTPR.
Absolutely. So the policy document comes out, it asks specific questions, asks for answers from taxpayers and advisors. And so you then got a specific time limit to send in your comments. Obviously, you can extend your comments to certain issues with the draft rules that have been identified, and then you get taxpayers and advisors send those comments in. The UK HMRC Tax Authority and the UK Treasury have been having a number of working groups with advisors and taxpayers to take comments on some of the issues that have been identified with the rules. But then the UK is taking those away and then feeding them into the OECD discussions that are taking place at the moment with the inclusive framework to essentially provide the administrative guidance, which we've heard there's no intent to actually go and revise the rules. So we'll have each country will legislate their own rules, basically taking that from the model rules, the commentary, and the implementation framework that we're expecting to get by the end of this year. So it's
there's a lot of
a
moving
bit of
parts.
a hodgepodge, a number of moving parts to then for the UK to take forwards and release the revised draft legislation I mentioned, because we have our draft legislation,
Right.
But as we say, those rules are moving. They're being debated at the moment at the OECD level, and ultimately where we get to in the implementation framework will be reflected in the revised UK draft legislation, which we expect spring 2023.
Right. So let me play that back, because I think one of the interesting things also about the UK is that the UK government will actually meet with advisors and taxpayers.
Yep.
In the US, it's very kind of formalized. We have this notice and comment period, and you provide written comments, and there's really no kind of formal meetings. But I kind of welcome that process in the UK, where advisors as well as taxpayers can actually engage in a dialogue, and there ends up being a back and forth. But I think one of your points is that what makes this particularly challenging is that the UK can't just say, listen, these issues that taxpayers and advisors are raising need to be addressed, and the UK will fix that, because if the UK starts to tweak these rules too much, there's the risk that it's no longer a qualifying income inclusion rule or QDM, or qualified domestic minimum tax. So what you're saying is the UK then has to go and talk to the OECD and the working party and saying, hey, taxpayers, advisors, stakeholders are raising these issues. We would like to address them, but we have this risk. So, hey, OECD, are you, particularly in the implementation framework, going to help, address some of these issues? Because I think, one of the things that we've heard is that there just does not appear to be a very big appetite from the OECD to really go back and revise the initial model rules and commentary.
Absolutely, yeah.
So maybe because there are a lot of questions and kind of uncertainties that we think that would be very helpful to be addressed as part of the implementation framework. And frankly, there's a lot of literature out there about potential improvements that we could see to the model rules and commentary. And when I say improvements, really clarifications, because this is solely highly complex. But maybe we just touch on a couple of those. The first being kind of asset transfers, and particularly with the consolidated group. So maybe you could tell us a little bit about what couple of those issues.
Yeah, sure. So I think that's one of the issues that's been identified by a number of taxpayers and advisors, is if you transfer your asset cross-border, then regardless of the fact that you'd step that up for accounting purposes, you bring in the historic basis for Pillar 2 purposes, even if that transfer has been subjected to tax at a rate over the Pillar 2 minimum of 15%. But we understand from the discussions that are taking place at the OECD that may get addressed. And if you're subject to tax at an appropriate rate on the transfer, then you would get that step up. So that's been an area of ongoing discussion with the UK, but I think with a number of members of that inclusive framework.
Yeah, and I think Callum had raised that on when we were talking about deals, because I think the most common scenario where we see that is where a company does an acquisition and then they have an intellectual property strategy, for example, where they consolidate, like I'll just use the US as an example, where the U.S. will buy, let's say, since we're in Spain, a Spanish subsidiary, because of some unique intellectual property that it owns, will sell the IP out of Spain. They just view the Spanish tax cost as kind of a cost of the deal. It kind of gets factored in, and bring the IP back to the U.S. And the issue under the model rules and commentary is that even if you've paid full boat tax in Spain on that IP transfer, the model rules and commentary tell you that the step up you get for U.S. purposes is not really respected for Pillar 2 because this was an internal asset transfer. So obviously the rules were designed to prevent companies taking IP from a low tax jurisdiction or not paying tax and trying to get a step up. And that, obviously, in the situation that we're discussing, is not the case.
Yeah, and that, actually, on that example you gave, you're buying that Spanish group, it's high tax, but one of the other issues actually we've been discussing is, well, what happens when the rules are in place and you buy a target and the target has IP in a low tax jurisdiction and you want to extract the IP and move it into your high tax jurisdiction where you're going to pay tax in excess of 15%.
Right.
Seems perfectly fine from a Pillar 2 policy perspective, but you're going to be subject to tax on the market value of that IP and integrating it into your structure if it is in a low tax jurisdiction and not taxed at 15% on that transfer. And there is a reorganisation relief in the Pillar 2 rules, the Globe Reorganisation Rule, but that is so narrowly drafted, we're struggling to find instances of where you can benefit from that. And so one of the discussions that we've had with the UK for them to go and discuss at the OECD level is whether we can extend that reorganisation relief to pick up those situations where you're acquiring a target and bringing the IP back. If you like, give companies a grace period to reorganise things in the group post-acquisition. So, but we'll have to wait and see. We add it to the long list of things we have to wait and see for.
Right, maybe just a couple of a few other ones because the list is long, but deferred taxes, and particularly looking at local accounts versus consolidated accounts.
So the issue there is under the Pillar 2 rules, you get to bring your deferred tax assets onto your opening Pillar 2 balance sheet, and so take the benefit as you utilise those tax assets and get to bring that tax charge that runs through your accounts in for Pillar 2 purposes to essentially increase your Pillar 2 effective tax rate. But as you know, Doug, you only get to take into account those assets to the extent they're included in your accounts. It's unclear from the rules and the commentary as to which accounts those are. It's subjected to interpretation, but it seems on an initial reading that it's more like the local entity accounts. But if you've got different accounting at the consolidated level, and say you can have different deferred tax assets there,
right?
You would think, given you're taking the income from the consolidated accounts, that you should be looking at the deferred tax numbers per your consolidated account. So that's a key area to clarify. But actually, for taxpayers, a key thing to do is to go through and scrub your deferred tax assets, because due to materiality levels, you might not actually be disclosing all the deferred tax assets in your group, especially because you can take into account like unrecognised deferred tax assets, or for US GAAP purposes, deferred tax assets that you'd have a valuation allowance against. So they go on your Pillar 2 opening balance sheet. So it's good practice to go through and identify what's there, and then hopefully we'll have the clarity as to which set of accounts you're looking at. If you don't get the clarity, I'd just disclose them in every set of accounts you have.
Matt, I'm just going to make a little comment on a side. I've worked for you for almost 25 years. The fact that we are now having a discussion about deferred tax assets, I didn't think that we would be here, but here we are. Really,
that's the tip of the iceberg.
I know.
On
these accounting issues.
We're having discussions on systems issues as well, which
we'll
we
get
haven't
there.
had before. We'll get there.
We'll get there. A couple of other quick issues also. So it also kind of from an accounting perspective and process, year-end adjustments. So talk about that. Briefly.
Briefly, I can talk about this for a long time. Essentially, the way the year-end adjustments works, it's a bit of a one-way street for Pillar 2 purposes. So, as everyone knows, Pillar 2 is coming from your consolidated accounts, but there's a high materiality level, and You start with your consolidated accounts, you adjust the figures for your local statutory accounts, you further adjust tax figures where you're doing your tax return, and those revised numbers in respect of a year, they go into your opening next year's consolidated accounts. And so Pillar 2 realises you'll have those adjustments and has a set of rules to deal with it. But as I say, it's just a one-way street, because in those tax numbers, if you overestimated the tax for Pillar 2 purposes, well, you go back, you adjust the return, you reduce the tax, and you pay more top-up tax. Seems completely fair. You've got the tax number wrong. It's understated, and so there's more top-up tax due. But if you'd, so it's overstated, more top-up tax due. If you've understated it, well, do you go back and say, actually, I shouldn't have any top-up tax? I realised on refining the numbers, my effective tax rate's greater than 15%. No refund. You just adjust the tax figure in the following year and put it through as additional tax for the following year. And the commentary is really clear on this.
Yeah, and just along those lines, I mean, besides just some of the adjustments that happen as part of any company's accounting process, the other kind of practical implication of that is transfer pricing, right? It's often there's a transfer pricing adjustment by tax authorities maybe 2 years later. So instead of being a couple of months later, right, 2 years later, whatever the case may be, and it's a similar one-way street, if there ends up being some sort of transfer pricing adjustment, there's no mechanism for taxpayers to go back and kind of refund that top-up tax
absolutely.
If there had been a similar type of transfer pricing adjustment. So whether it's an accounting adjustment, transfer pricing adjustment, whatever the situation may be, taxpayers are very incentivized to get this stuff
to get the numbers right
the first time, which we know is not
back
always
to those systems we were saying we get to.
So the other issue that I've gotten a lot of questions on, and I know there's been a lot of commentary on, are how does consolidation work? Where does the obligation for the filing and the payment of Pillar 2, and particularly with partially owned parent entities. And so I've seen this kind of not in the private equity context, just in multinationals, joint venture, in various credit type structures for investment credits and the like. And so I think that we're also hoping maybe and maybe the UK will lead the charge on this, or working with the OECD on just getting some more guidance on how that works in that joint venture type
or
of structures.
revising that process, because as you said, that partially owned parent entity, if you've got a JV with a minority shareholder with 20% or more interest, then you're a Pope. So what's the Pope doing in Pillar 2? But no, it's a abbreviation, partially owned parent entity, and in that situation, the top-up tax is paid by the holding company, the joint venture holding company. The tax is at that level. But as we know, when you calculate the top-up tax, it's a jurisdictional blending basis based on all the entities in the group. And so if you've got low taxed entity in a jurisdiction in the majority shareholders group, and a company in the same jurisdiction in the joint venture, which say has a Pillar 2 rate at 15%, no top-up tax due, well, it gets blended with that low tax activity in the majority shareholders group, and your minority shareholder is economically bearing a top-up tax cost of entities in the majority shareholders group, and that is causing some consternation with minority shareholders. I think they've got a fair point. It's getting picked up in JV agreements, shareholder agreements going forwards. But obviously, that's on a prospective basis. If you're sat there with an existing joint venture, I think you're going to get short shrift if you go back to try and negotiate the majority shareholder paying you some money back.
All right, so let's kind of hear towards the end. We haven't really talked about some of the systems challenges, and you and I are international tax advisors. We've been our entire careers, and I've spent a lot of time over the last year talking to you about accounting and systems. And so, as you've been working with taxpayers on Pillar 2, what are the biggest challenges? Is it systems and data?
100%, Doug. So we're doing impact assessments, getting in there and modelling what the impact may be, but in some instances, we're seeing unexpected top-up taxes in high-tax jurisdictions. We've seen the UK and the US actually being below 15% for Pillar 2 purposes. But in all those impact assessments that we've done, The issue's been getting the data. There's been operational issues and data gaps, and we've just picked 60 of the data points to do our modelling when we're doing it in more detail. And clients, I think, and we've heard actually in this conference that they've probably actually only got a third of the data points that are required easily at hand. Then they can, from other areas, manually add on a third, and then there's a third that just doesn't exist today because it's a third set of books. There's data points that aren't being used for accounting purposes, aren't being used for tax returns. Companies need to set up processes to be able to get this additional level of granular data to do the Pillar 2 calculations.
Yeah, and I think that's really the important message, I think, for advisors and for taxpayers, is to start early. The UK has now, they're kind of out there. We'll see who else kind of queues up at the front of the line. But as you said, as we've thought about this, we've got 60 data points. Well, as you know, we also have a more inclusive data input catalog with 260 data points. And so as we've seen taxpayers struggle to even get those 60 data points, as we think about really trying to comply with these rules, and we'll see what the compliance looks like as we get the implementation framework, but it really is the biggest challenge. And I think one of the things that I've learned is that there's not going to be one source of data. Like the information that is required to do these calculations doesn't just sit in an ERP system. And I think that has been a surprise to many advisors and taxpayers as they've started to work through this. It ends up being a number of different sources of within a company, and oftentimes companies have multiple ERP systems.
Yeah, absolutely.
And so whether it's multiple ERP systems and then any other systems, it really is a big challenge.
Oh, it really is. So yeah, there's no automating your end-to-end process. You've got your ERP systems, your manual data, plugging those gaps, those 260 data points per constituent entity in the group.
Right.
There's a hell of a lot of data points there that you need, and so it's getting those data points from all the sources and then putting them in your data warehouse. Another term we've been using that we wouldn't have done in our
in our prior
pre-Pillar 2 lives.
That's right. All right, well, Matt, this has been a fascinating discussion. Amazing, here we are, and the UK is out there now. I think this is a game changer, and I think frankly for a number of our colleagues and a number of taxpayers that have questioned whether this could happen, that the message and the important lesson is get ready, because this takes some time, and to bring the appropriate stakeholders involved. It's not just international tax folks, it's systems folks, it's accounting folks, it's tax accounting folks. There's a lot of people, a lot of stakeholders in this process that companies really need to organize.
Absolutely, and we've heard from a number of taxpayers at this conference, and they've shared that, that process takes months getting everyone on board, and it's basically start now, gathering that data, filling in the missing data points, working out how you're going to do the calculation, and then ultimately having that whole end-to-end process in place. And it's not for 2024, it's for reporting in your accounts as well. For all the listed companies, if you're making any forward statement as to what your effective tax rate is going to be, you've got to take Pillar 2 into account.
Right.
So it's a short timeline.
And that's a perfect hook, because at some point we're going to have a discussion where we get some guidance from the International Accounting Standards Board, ISB, on whether this will be accounted for as deferred or current period. So we're waiting for some guidance.
Watch this space,
watch this space. So we'll see some of that. So Matt, thank you very much for joining.
Thanks, Doug. No, it's been great.
So thanks for tuning in to this week's episode of Cross Border Tax Talks. Thank you, Matt Ryan, PwC UK International Tax Partner and Pillar 2 Guru. I'm Doug McHoney, PwC's International Tax Services Global Leader. Stay tuned in 2 weeks for another exciting edition of the Cross Border Tax Talks podcast.
This podcast is brought to you by PwC, all rights reserved. PwC refers to the U.S. member firm or one of its subsidiaries or affiliates, and may sometimes refer to the PwC network. Each member firm is a separate legal entity. Please see www.pwc.com/structure for further details. This podcast is for general information purposes only and should not be used as a substitute for consultation with professional advisors.